Last Friday delivered one of the most shocking jobs reports of 2026. July payrolls fell by 23,000. The economy actually shed jobs. Previous months were revised sharply lower. The unemployment rate dipped to 4.1%. Let me put this in context. June was already a shock at 57,000, half of what economists expected. Now July came in at negative 23,000. The economy did not just slow down adding jobs. It went into reverse. The week of August 10th begins with markets bracing for the July CPI report on Wednesday, now more important than ever given the jobs data. Economists expect headline inflation at 3.4% and core inflation at 2.5%. Here is the extraordinary paradox the Federal Reserve now faces. The economy is shedding jobs, which normally demands rate cuts to stimulate growth. But inflation is still at 3.4%, nearly double the 2% target, which normally demands rate hikes to cool prices. These two signals are pulling in completely opposite directions simultaneously. This is called stagflation. Risk, the most difficult economic environment any central bank can face. Kathleen Brooks, a market analyst, put it clearly, inflation data is arguably more important than payrolls right now. A hotter than expected CPI on Wednesday could push September rate hike expectations higher even with the economy shedding jobs. What the unemployment rate contradiction means. The unemployment rate dipped to 4.1% even as the economy shed 23,000 jobs. How can unemployment fall when jobs are being lost? When people stop looking for work, they are no longer counted as unemployed. A falling unemployment rate alongside job losses is not good news. It signals workers are leaving the labor force in frustration, rather than finding employment. What you should do right now. If you work in any industry sensitive to economic cycles, retail, construction, finance, real estate, hospitality, this is the clearest signal yet to extend your emergency fund to at least 6 months. Economic slowdowns arrive slowly then suddenly. The time to prepare is before the impact arrives at your specific employer.